but we promised you some global opinion. Marc Faber of the Gloom, Boom and Doom Report is going to talk about exactly that. Marc, good morning. Happy New Year first off to you. What's the expectations you would have? Thank you very much. What's the expectations you would have of 2012 from the equity markets, given how bad last year was for equities worldwide?
Well, I mean, we have strongly tried the statement how bad it was for equities worldwide, because the U.S. market was basically flat, and it significantly outperformed most other markets in the world, in particular emerging economy stock markets. In other words, say India, currency adjusted, was down something like 30% last year in dollar terms, and the U.S. market was flat. So what we had in India is an underperformance that resembles the underperformance we had in 2008 that led to a major buying opportunity. And so I think that what we will have in 2012 is initially maybe some further weakness in emerging economies against the U.S. market, and then a major low in emerging stock markets, including India. In other words, I was always looking for India to bottom out on the Sensex between, say, 12,000 and 15,000, and we are getting there slowly.
Marc, good morning. It's not just India, but all the BRIC markets fell off between 20 and 30% in dollar terms last year. Are you expecting significant outperformance from those markets relative to the U.S. in 2012?
Well, not right away, but I think, as I said, what we had in 2008 was the outperformance of the U.S. and emerging economy stock markets, and commodity markets really got hit very hard. But it led to a major low in emerging stock markets that bottomed out between October 2008 and March 2009. And after that, emerging stock markets outperformed the U.S. until, say, the end of 2010. So I think we may get a similar picture. And that's why when I read all the strategists who argue you should invest in the U.S., I say, yeah, maybe that's correct for the next 3 months or so, but I would rather be looking at an entry point into markets like India over the next 6 to 9 months.
As you pointed out, though, Marc, a lot of equity market performance was driven by what happened in the currency market. For this year, what would you say is the likely outcome on parameters such as the dollar index, what happens with the euro dollar, and how currencies generally are impacted by that?
Well, that's a good question, and I'd just like to mention, to make forecasts about free markets is very difficult. A free market and a perfectly functioning market is a market where no market participant has a dominating influence on the market. But today you have actually manipulated markets. You know, the governments intervene continuously, particularly with the price of money, in other words, interest rates and fiscal policies. And so to make any prediction is a political issue. We don't know exactly how far the ECB in Europe will monetize and at what stage QE3 will come about in the US. But should the S&P drop here 10%, you can be sure that there will be more QE in the US, and so the markets will be supported by additional liquidity injections.
Where does all this leave the commodities market, Marc, for 2012? If you had to take calls on gold and crude, how do you think they will do this year?
Well, I mean, we have to distinguish between precious metals and industrial commodities. My concern is that the Chinese economy is going to be weaker than is expected, and that the demand for industrial commodities will probably disappoint. And so I'm not particularly keen on buying industrial commodities at this stage. In the case of gold, as you know, we had a 10-year bull market, and we peaked out in dollar terms on September 6, 2009, 2011 at $1,921, at which stage the gold price had somewhat overshot on the upside, and we are in a correction phase. I happen to think that the correction phase is not completely over, but recently sentiment on both silver and gold has turned very, very negative, and so we may have a trading rebound here, a trading rally, and then some further weakness into possibly February, March, and then probably a major low. And then the question will be, when the precious metals rally again, will they exceed the peak of 2011 or not? That will be then the big question.
By how much would you postpone expectations of a big up move for equity markets, Mark? When do you think there will be a clean resumption of a trend, or possibly the potential for markets to get into a bull phase again? How much would you push that expectation back?
Yes, this is a very good question, because essentially what you could get in the world is worsening geopolitical and economic conditions. Say, let's say Israel attacks Iran. It's a negative event, basically, but it could be countered by monetization everywhere in the world. In other words, liquidity injection. So stocks could go up while conditions worsen. This usually happens when you massively inflate the quantity of money. But a fundamentally sound market, in my opinion, will only come about when the system has been cleaned and what is done after the financial crisis of 2008 is essentially just painted the building with fresh paint, but we haven't addressed the fundamental problems of the Western world, which is an over-indebted society.
Thanks very much, Mark, for joining in today. You have a very good 2012. Appreciate your time. That's Marc Faber with his predictions for 2012 and how he sees